10-year note yields declined modestly ahead of the holiday we have coming up this weekend as we failed to move back into the old range. Remember that old range from basically the first quarter, the 260 to 280 yield range we saw? We tested both sides of it. We spent a lot of time in the midpoint, and then come March FOMC, we saw a big decline in yields. That pushed us all the way down to the year-to-date lows, and we've since crept back higher. And since those FOMC minutes from the March meeting, we've seen an accelerated move higher back towards 260. And this week we actually nudged up right next to it within a basis point, and we were unable to push through it. And so the market just settles just below that level. But again, that'll be a key level to get back into. If we go back into that old range, it really means that it's going back to the status quo. The data's okay. The Fed's on hold. There isn't anything really exciting going on. It'll become sort of a tug of war between how long we go back and stay at that 270, 275 midpoint, or do we go north to 280 or back to 260? And that's kind of the range that we traded for most of the first quarter. And since that March meeting, it's been a lot of zigzagging trade, but now we're starting to see it push back up, but unable to get back into that range ahead of the Easter weekend. And if you look at market volatility, it spiked highest when yields were at their lowest, and ever since it's been sort of creeping back lower. We did near the year-to-date lows last week as we saw yields continue to creep higher, but we're hovering right around the 14-day moving average as of today's close. And really, again, that's just telling you that the market isn't really seeing anything out there that's going to alarm the bond market or that's going to see a significant shift like we saw after March FOMC. So I think at this point, all expectations are that we'll go back into that old range before too long, and whether it's because of better data, stronger earnings, or a Fed that maybe wants to see the glass half full, the Treasury market doesn't see any fear of another move back to the lows in yield. So right now, volatility kind of hovering on the low end, but certainly right near that 14-day moving average as yields failed to get back into the old range. But next week we'll give it another shot. And lastly, what is going to be the big event next week? Well, GDP for first quarter, the advanced first quarter GDP will come out on Friday. I know that's a long way off, but I think it's a number that the Fed and most economists will hang their hat on for basically a look back at what was. And expectations have ranged all over the map for this, starting sub 1%, which was something that would be a real thorn in the Fed's side, to today we get the GDP now from the Atlanta Fed that came out around 2.8. So we're nearing that 3% level, not quite there, but certainly this would be a relief to see a 2.8 after the early expectations were so low. And again, another reason why we'd see bond yields move back higher as things ease, as the economic risks start to fall off a little bit. Certainly there's always geopolitical risks. Certainly there's always some kind of foreign government risk, foreign central bank risk, counterparty risk, you name it. The equity is still sitting on near all-time highs. That's always a risk as well. But I think at this point right now, we're just going to see steady as she goes. Next Fed meeting comes in May, not expecting any kind of policy shift, not expecting any kind of tone shift like we saw in March. And I think that the market right now could enjoy a summer where we just kind of go back into the range and kind of bounce back and forth until some catalyst event moves us outside of that range. I think at this point, the Fed would be very happy with that. Looking forward to the second half of this year when, no, they're not going to be raising or cutting rates, but at least they can then start to build a new future with the idea that if the economic data comes in strong in the second half of this year, that 2020 won't be a year to cut rates, but maybe another year to hold them steady to possibly raising them. That would be ideal. Right now, the market's anticipating that they'll be cutting rates in 2020. So bond yields right now hovering just below that first quarter range. Next week, we have GDP. A strong number could get us over the hump.